Now we are going to understand about the discrete processes, where a few important concepts that we are going to look at, one being the binomial branch model. Then we'll talk about what do we mean by binomial representation theorem by defining some essential concepts that go as the input into the binomial representation theorem. We will be defining what do we mean by filtration. We'll talk about what do we mean by the conditional expectations operator, and we would also be talking about the pre-visible process. And once we define the binomial representation theorem, we'll see how this theorem would be applicable for the financial applications, especially the stock price movement. And again, within this context, we will also be using what is called as a self-financing strategy. So what do we actually mean by that? So this is a smaller chapter where we would be talking about these basic concepts itself. Okay, so talking on the binomial branch model, we know that in terms of a stock, we see that the price can either go up. Let's say I'm talking about some stock price S1 as of today. It can go either to S3 after a certain small time period delta t. It can either go to S3 up, or it can go to S2, which is down. But it is unpredictable. There is a random component that goes into it. That is what we are talking of the movement of a typical stock. When we talk about a bond, we are talking about one constant interest rate which is continuously compounded from the period 0 to delta t. So which means if I have invested $1 right now, it is going to give me e to the power of r delta t at the end of the delta t time period. And we are able to, we are making an assumption that we are able to lend at that rate, borrow at that rate, and whatever is the size, the amount that we want to lend or borrow, which is like unlimited lending and borrowing can happen at the risk-free rate. Now, the biggest problem comes of the randomness of the stock values. So the market, I don't even know which of these two things the market is going to take at the end of delta t. The only thing is, because of this uncertainty, now there is a kind of a market for the instruments whose values depend on the stock price at the end of the period. That is where the derivatives, the fixing, reducing that uncertainty of the stock price at the end of that particular delta t period, the instruments have been created which are typically your derivative instruments. And now we know, based on our understanding, we are going to find out what is the probability that the price is going to go up and the probability the price is going to go down. And we can even find out the expected value of this particular outcome at the end of the period, but we don't know what would be the actual value. It might either be S2 or might be S3. So the expected value, I can very well find it out like this. And if at all I really want to find the price of that derivative, I will discount this expected value to the present value and say that that is the price of a derivative. But that will not eliminate my uncertainty part. Now this is where we are thinking of bringing both these instruments, stock and bond, together, create a kind of a general portfolio. Like I invest 5 units in the stock and psi units in the bond. So right now at the beginning, let's say when I'm investing 5 units in the stock, the value will be 5S1, and psi units in the bond, initially let's say the bond price is B0, so it will be psi times B0. So right now the price is, right now my portfolio is worth phi S1 plus psi B0. Now assume now imagine if the stock price goes up. So the same 5 units of the share, the price will go to S3. and the psi units of the bond, the price will become B naught into e to the power of R delta T. So this would be the price when there is an up move, and when there is a down move, the price will go to S2. So the value will be phi S2 plus psi times B naught e to the power of R delta T. Now, if I am talking about a derivative, if the stock price goes up, let's say the value of the derivative is f of 3. If it goes down, the value of the derivative is f of 2. Based on that, I can find out what are my phi and psi, because it's a two linear equations in two unknowns phi and psi. So probably if I am subtracting one from the other, I get phi times S3 minus S2 is equal to f of 3 minus f of 2. Right, because these two are going to cancel off. So from here I am getting my phi is f of 3 minus f of 2 by S3 minus S2. Whatever it is, the difference in the stock price is the denominator and difference in the price of the derivative is the numerator. So I am getting my phi, and I can very well substitute the same. Right, f of 3 minus f of 2 divided by S3 minus S2 plus psi times B naught e to the power of R delta T is equal to F3. So psi very much comes out F3 minus of f of 3 minus F2 by S3 minus S2. Right, and B naught, multiplied by B naught, they are divided by B naught e to the power of minus R delta T. This is what is coming out as, and even you have S3 as well. So this is what is going to work out to be your psi. Now with this, what has happened is, by investing in phi units of the stock and psi units of the bond, we have synthetically created the derivative. Without actually investing in the derivative, we have created the payoff of the derivative. And in a way, if I keep changing it on a regular basis, this portfolio also becomes a kind of a self-financing portfolio. We'll talk about this self-financing again sometime later. But see, it will very much come out that I'm shorting on one and going long on the other, which means I'm raising the financing to fund the other. Internally, by shorting, there is a capital that is being raised, which means no additional funding is coming into this kind of a mechanism. So we have first of all synthesized the, but one thing right now to look at is, we have synthesized the payoff of the derivative just by using the stock and the bond. And this price is always right. And which means I can very well make a statement, any derivative can be constructed from an appropriate portfolio of a bond and a stock. I can very well replicate every derivative in terms of a stock and a bond. And this derivative is always constructed in advance. Right? This derivative I am always constructing in advance, and probably it is very much enforceable as a rational price. Now I can talk about phi. So right now, if I want to find out the value of it, it is nothing but S1 times phi plus e power minus RT times psi or B naught. So we are taking e to the power of minus R psi times e to the power of minus RT, which is what is coming out as the value of the derivative or value of this particular combination portfolio, which is nothing but equivalent to that of a derivative as of the current period. That's one of the interesting aspects that come by understanding the binomial branch model. And if any other market maker is offering to either buy or sell the derivative at a higher price or at a lower price, I can very well create an arbitrage opportunity. If it is for a lower price, I'll buy the derivative, sell the portfolio that is matching with this. If it is for a higher price, I'll sell the derivative, buy the portfolio matching with it. And this set of trades at the future, both of them are giving me the same payoff, which means they don't have any kind of a risk, which means they should give me risk-free rate of return. So the profit that I am making either by selling it higher or lower is what is a risk-free profit. That is what we are calling as an arbitrage profit. And if I am linking the same back to the expectations, I can very well talk about the price, the probability that the price goes up. I can choose, if I choose the P, which is the probability of the price going up, I can choose it as S1 times E per R delta T minus S2 by S3 minus S2. The proof of this we are proving in another session on the binomial model itself. Now we will be moving to the next concept, which is the binomial representation theorem. For that, I want to define a few terms before we define the binomial representation theorem. And because of that, I am taking a simple example. Okay, I'm talking about the stock price up down at the end of time 1. Again, two possible moves up down at the end of time 2. And these are the prices which we are talking of. From 80, it can go to 120 or 60. And again, if it had gone to 120 at time 1, it can either go to 180 or 80. If it has touched 60, then there is a chance that it can go to 72 or 36. And we are talking about two different kinds of probabilities here. Alright, the first one we are calling it as a P probability measure P, and this we are calling as a probability measure Q. So this actually we can look at it like a real world probability, and this we can call it as a risk neutral kind of a probability. Now whatever it is, so there are different chances that the price can go up or go down at different points in time. That is what we are seeing here. So from here, let's try to go step by step. We'll call the set of possible stock values. So these are the possible stock values, one for each node of the tree. And the patterns, interconnection, this entire thing, we are calling it as a process. The way the stock price is going to behave at different points in time. That is what we are calling as a process, one for each node of the tree. So this is one process. This is one process. This is one process. This is another process. Okay. The random variable Si is talking about the value of the process at time I. So it's like S1 equal to 80, S2 or S0 equal to 80, S1 is 120, S2 is 180. Or it could be any other combination. Separate from the process S, right? I'm not dealing it with here. I'm talking about a set of probabilities that the price will either go up. This I am calling it as a P measure. This I am calling it as a Q measure. How likely the up or down movement at each of the node can be. And here, whether I take this or this, we did not need the real world measure P in order to find the measure which allowed the risk free. We really don't need it, this measure. Even in this measure, I can make it more and more risk free. Size and the interrelation of the up moves affect the values of the derivatives. So if you remember, the up movement, we said e to the power of sigma root t from a binomial tree model. So It is the size and the interrelation of the up moves which affect the values of the derivatives, but it's not the probability at which the price is going to go up or go down. Whether I take this probabilities or whether I take this probabilities, it hardly matters. Here, we'll define one more term called filtration. It is nothing but it's the history of stock price up until the tick time I. So when I am looking at node 1, the filtration is only up to the node 1. If I am looking at node 3, the filtration means the process up to node 3, which means these two. If I am talking about node 6, the process up to 1, 3, 6. These are the three nodes that come under filtration for node 6. So that's how we get the filtration. That's the definition which we have to be comfortable with. So it fixes a history of choices and thus fixes a node. So for each node, I get a history. Then if I have to define the word claim, it's a function of the nodes at a claim time horizon t. Now at a time horizon t, when I am looking at, probably if I am looking at these four, now the prices at this 4, 5, 6, 7, 180, 80, 72, 36. And now when I say that the claim is anything above 70, max of, that is the definition of the claim, let's say, max of this price at the time period 2 minus 70, comma 0. So that's where I get this one. Right? Or if I am saying the claim is max of S0, S1, S2. So in this case, again I am getting, so for 6, this is what I am getting. For 5, this is what I am getting. So finally it is, so either I can get this kind of a claim, this kind of a claim, whatever it is. Now the claim is only defined on the nodes at time t. I am not basing it on before S0, S1, I am not considering them. At time t, what is the claim? That is based on the node at time t. But when I am talking about a process, it is going right from the S0 till St. That's where we differentiate the claim from a process. Then one more important term that I have to introduce before I define the binomial representation theorem is the conditional expectations operator. The expected value based on the Q type probability of any given Fi. So given the value up till Fi means given the value up to, let's say, F1, given the history of events up to F1, I want to find out the expected value of S2. Right? I want to find out the expected value of S2. So which means until the time period 1, I am already given F1. Let's say this is what I am given. And then I want to find out the expected value of this. And now let's say this is the probability 2 by 5 times 180 plus 3 by 5 times 80. So this comes out to be 36, 72 and 48. So this works out to be 120. So expected value of S2 given F1 is what? F1 equal to 120. So the same way I can go with given F1 equal to 60. That is where we are going into and conditional expectations kind of an operator. For any claim X, the expectation of X along the later portion of paths which have an initial segment Fi. So it is an enforced dependence on the valuation of the filtration, and so it's a random variable in itself. So that's one thing. Conditional expectation is some understanding we need to have. Then we are talking about a pre-visible process phi. The only difference between the pre-visible and the filtration is I'll not have the value of fi. I'll know the values only up to fi minus 1. So the process on the same tree whose value at a given node at a time I is dependent only on the history up to one tick earlier. So which means the price at time 2 is dependent only on F1. The values up to F1. Right? So that is what we are calling it as a pre-visible process. So it is compared to the main process as it's known one node in advance. And it does not seem to notice the branches until one time step after they have happened. And this is a very important role in trading strategies where I can't say what would be the price of tomorrow, what would be the price in the future. So I'll not have the value up to that particular time point. I'll have only up to one period before that itself. So majority of the applications come down as the pre-visible processes only. And now when I know only up to F1, if I want to find the expected value of S2, so it depends on whether it is 1, 3, this is the expected value. If it is 1, 2, then this is the expected value. And if I am going with the expected value given F naught 2 periods earlier, so from 1 I am purely looking at all possibilities. But if I am going with this, it's a value which is fully known. There is nothing like an expected value there. And then one more interesting part that we are bringing in here, the whole process is a martingale with respect to the measure P and the filtration Fi. Just try to look at it. Expected value of S2 given F0. How much did we get here? With respect to P we are trying to look at. Okay. So here let's say expected value of S2 given F0. Okay, half of 180 plus 80 plus 72 plus 36. Is this half of? So this is half of these two plus half of these two. So overall it's working out to 260, again 120, 260 plus 108. 260 plus 10. So here it comes to 130 and here it comes to 54, which works out to 184. Right? But I have to take it as, if I'm going, or probably I have to take it, let's say, with respect to each of the nodes. Right? So half of 180 plus 80, 260, which is 130. Again half of 72 plus 36, 108, which is 54. And again I have to take half of 130 plus 54, 184, which comes out to 92 under the P-type probability. But if I am going under the Q-type, it might come out to be exactly equivalent, okay, 2 by 5 times 180 plus 3 by 5 times 80, which is 120. 2/3 of 72 plus 1/3 of 36, 48 plus 12, 60. Again the same, 1/3 of 120, 2/3 of 60, it is working out to be 80. Now, what we really want to see is a process is a martingale with respect to whatever is the measure if it works out with this kind of relation. The expected value of Si with respect to under a filtration Fi Sj under a filtration Fi, it is equal to the Si, means the drift is 0. Future expected value at time j of a process S under a measure P conditional on the history up to time A is equal to the expected value at time I itself, which means in that case the process S has no drift under the probability measure P. And what we simply say is for any claim X, the process X given Fi is always a P martingale. And that is where the Tower law comes into picture. If I am doing it like expected value of X given Fi, it's as good as expected value of X given Fj given Fi, find the expected value of that. Conditioning firstly on the history up to time j and then conditioning on the history up to an earlier time I is same as conditioning up to the original time up to I itself. So that's where I don't need to really do it for time j, and every time I get it as a P martingale itself. Now, what does the binomial representation theorem talk about? Suppose the measure Q is such that the binomial process S is a Q martingale. In case I am able to get a particular process a Q martingale, we are seeing that example is a Q martingale. If N is any other Q martingale, now here we are saying the binomial process, that stock price has moved as a Q martingale. Now I am saying some other N, some other price movement, some other stock movement is also a Q martingale. Then what we are saying is there exists a previsible process phi such that Ni at the ith time period I can go with N0 plus some phi times delta Sk, where Sk is coming from the price difference associated with the binomial price process. So I can express it, I can express N in terms of S and do the pricing for the same. That is what is the binomial representation theorem talking about. So the phi I could change, it's a value of phi at a particular time tick t. So this could be a dynamic kind of a number. So consider a single branching from time tick I minus 1, it can go up or go down. And the structure of the tree is ensured in such a way that the history Fi has two choices from Fi minus 1, one to up and one to a down. Now I can find out whatever is the change between the up and the down. I can look at the difference between some other process N, the difference between up and down. Based on that I am getting my phi I as the ratio of these two differences. And that phi I is what I would be using for predicting the changes in Ni from the next onward, because that is a martingale is what is the concept that we are bringing in. So what it is simply bringing out is if S and N are Q martingales, right, we are directly getting as the delta Ni is always established in terms of delta Si multiplied by a previsible process phi I, and that is so, which means I can express the change in the value of one variable in terms of the change in the value of the another variable by understanding the previsible process that is associated with that particular variable, with that particular set pair of variables. That is what is being brought about by the binomial representation theorem. And when we talk about from a financial application perspective, we know that the stock price follows a binomial process S. And so from that, okay, if there were a Q measure which made S a martingale, I'll take a Q measure which could be a risk neutral kind of a measure which could make S as a martingale. I'll find the probabilities which could make S as a martingale. We could use the binomial representation theorem to represent some other martingale Ni in terms of the stock price. And I can very well use the previsible process from that binomial representation theorem to act as a construction strategy for me. So based on that, I could buy appropriate phi I of the stock which would be simulating, or probably which would replicate the kind of gains and losses with respect to the martingale NI. So we can match the martingale step for step, where it is starting, where it is ending, whatever that might be. And if the martingale ended in a claim, then that claim also I can very much synthesize through this kind of a setup. And in this context, when we said that I am going with a strategy of 5 units of stock and psi units of the bond, we are creating a self-financing strategy which can duplicate any kind of a claim. And whenever I am saying self-financing strategy, there is no exogenous infusion or withdrawal of money. Whatever comes from a short position is sufficient to go for a long position, and vice versa. The purchase of a new asset must be financed by a sale of a old one itself. Here we are able to create a kind of a self-financing strategy. First of all, I know phi and psi, how many stocks have to be bought, how many units of bond needs to be invested in, so they are pre-visible. Change in the value of V obeys the difference. Going with the change in the value of V is same as phi times phi I times the difference of SI plus psi I times the delta of BI. So it is following that kind of a relation, and at any point in time, which is the maturity period, phi t times ST plus psi t times BT is always equal to the claim amount X. When I am able to make these equations satisfied, then obviously my portfolio is becoming more and more self-financing itself. So this is what we wanted to cover as a part of this session. A quick understanding of the binomial branch model, the binomial representation theorem, where we introduce some important concepts like filtration, conditional expectation, previsible process, then looked at the financial application of the binomial representation theorem, and had a quick understanding of the self-financing strategy. Alright, thanks a lot.